Learning how financial markets work starts with understanding why prices are generally stable, says Paul Wenger, CEO of the mutual fund giant. Not only do prices generally move up and down over time, his argument is that a market is a critical system that is very difficult to create an equilibrium in. It is inherently unstable. How do prices move? All prices reflect many things, Wenger says, including the supply and demand for any particular asset. A market's prices are a collective expression of its members' attitudes. Someone may say they want to buy, someone may say they want to sell, and there's also the thinking of an external factor. One person sees a specific event or one particular thing. For example, when a given product, a stock, or a bond price goes up or down, people might be responding to the news, the economy, political and social events, or a person's emotions. When those prices rise or fall, all people affected have a reason. There's a price for that product, but it also has to take into account the other people who are selling and buying, and other external factors, Wenger says. How prices can be manipulated. Some people in the market may have ulterior motives for manipulating prices, says Wenger. These individuals, who might include company insiders, market makers, traders, and brokers, may act independently or as teams to manipulate prices. Any of those traders could artificially shift the price of an asset so that it looks like it has an irrational movement, he says. When you can't answer one or more of the following questions, you know that something is amiss in the financial market. Why hasn't the market moved? What caused the price to move in a particular direction? What caused the price to move in the opposite direction? If you can't figure out what happened to the price, you know someone else was likely the source, says Wenger. There's more to creating an equilibrium in the market than simply trading and transacting. Market makers, for example, are buyers and sellers who help balance the demand and supply in the market. To use the price of gold as an example, when the gold price is falling, its price could be creating an equilibrium, where people who are selling gold in an effort to create a stable price are doing so at the expense of those who are buying. Similarly, when the price of gold is rising, it might create an equilibrium where people are buying more gold because they see a more favorable opportunity.